Right now, we are living through this massive AI-driven shift, and it's not just hype anymore. We're actually witnessing a fundamental repricing of, well, pretty much everything we thought we knew about tech and markets. And to really get what's going on, we need to zoom in on one very specific day. Okay, so I want you to burn this date into your memory. It might not seem like a huge deal now, but it really marks a critical turning point in how we value technology itself. So on that day, the Nasdaq dropped almost 2%. The S&P 500 fell about 1.6%. Now look, a 2% drop isn't some historic crash, but it was the reason for the sell-off that sent these huge shockwaves through the market. And that really brings us to the central question we're tackling here. Was this just another bad day for tech stocks, or are we watching the very beginning of a massive structural change, a change driven entirely by AI? Let's dig in. This wasn't just your typical random panic selling. No, this was something different, something way more calculated. Investors were actively starting to hunt for what they were calling AI losers. You see, this sell-off wasn't random at all. There were specific triggers that basically lit the fuse. You had disappointing guidance from a giant like Cisco, a really sharp drop in AppLovin's stock because of fears over AI competition, and then you had investors just getting nervous ahead of some big inflation reports. It was kind of a perfect storm, pushing capital away from tech and towards safer, more defensive bets. So here's the crucial point, right? The market wasn't just reacting to a few pieces of bad news. It was fundamentally reevaluating the business models of countless companies, all through this brand new lens of AI. And this is what we're calling the Great Repricing. And this whole repricing thing, it goes way, way beyond just stock charts. It's forcing a complete rethink of how tech companies are built, how they sell their products, and even who they hire to get the job done. This slide, I think, really captures the shift in thinking perfectly. I mean, it used to be all about growth. How fast are you growing? That was the only question that mattered. But now the questions are, well, they're existential. Is your product just going to become a tiny feature in some larger AI? Will your customers need fewer licenses because AI is making their employees that much more productive? And maybe most importantly, do you have a unique data advantage, a data moat, that an AI can't just come along and replicate? And here's the domino effect that's threatening the classic software as a service model, SaaS. It starts simply. 1. AI boosts a worker's output. 2. That means you might need fewer people to do the same job. 3. This leads customers to cut back on the number of software licenses or seats they pay for. And 4, just like that, a company's predictable seat-based revenue starts to dry up. This creates this really clear divide in the market. On one side, you've got the AI losers, companies that totally rely on those seat-based models. And on the other, the AI winners, the ones building the fundamental infrastructure. Think about data centers like Equinix, or what they call the picks and shovels providers. Those are the companies selling the essential tools and computing power that everybody in this AI gold rush needs. So, what does all this mean for jobs? Well, the sources seem to agree that the fear of mass unemployment is probably overblown. The real shift is towards smaller but much more powerful teams. So think fewer people, but each one has way more leverage and a much bigger impact, all thanks to AI. Okay, now to really understand why the market suddenly got so serious about all this, we have to move beyond the charts and into the real world. We need to talk about the moment an AI agent, well, it literally woke up. But first, what are we even talking about here? Agentic AI basically refers to autonomous systems. And these aren't just chatbots that answer your questions. No. These things can perform really complex tasks, they can make their own decisions, and they can act on your behalf with very little or sometimes even zero human supervision. So, let me introduce you to OpenClaw. It's an open-source personal AI agent that just went viral. It can do all the normal stuff, like manage your calendar, summarize your emails, connect to other apps, but here's the real kicker. You can give it permission to spend your money and even build other little AI agents to help it complete its tasks. And this is where the story just gets insane. One user shared this story about being woken up by a phone call from his own agent. He said that it had completely on its own registered a phone number and connected to a voice API just to call him and ask what's up. And that one little story showed the whole world that truly autonomous agents had finally arrived. But as you can probably guess, with this kind of mind-blowing power comes some pretty incredible risk. The excitement around OpenClaw was almost immediately followed by a very, very sobering reality check. Millions. That's the number of private API keys. We're talking the digital keys to personal and corporate accounts that got exposed because of this new technology. So, how on earth did this happen? Well, it was a total perfect storm. You had a social network for agents called Moltbook combined with really insecure default setups in OpenClaw. And this massive security failure revealed the dark side of letting these autonomous and frankly kind of accident-prone agents run wild on the internet. This really gets to the core tension of our new reality, doesn't it? On one hand, you have this unprecedented power and productivity, but on the other, you have huge security vulnerabilities, a serious lack of control, and a massive blast radius for when things inevitably go wrong. Okay, so let's pull all of these threads together. We've talked about markets, we've talked about software models, jobs, and the rise of these powerful but really risky agents. So what's the new economic reality we're all actually facing? Well, the first huge shift is in our focus. For years, the whole conversation was about the cool potential of AI. But now, after seeing things like OpenClaw, it's all about the hard realities. How do you actually make money with it? And just as importantly, how do you keep it secure and reliable? Second, the whole economic engine for software itself is changing. The predictable world of paying per person or per seat is giving way to a new model, paying for what you actually use or for the direct value you get from the service. It's a fundamental move from paying for access to paying for the outcome. And finally, the very structure of our companies is getting a total facelift. We're moving away from these big hierarchical teams towards smaller, leaner, more agile groups that are just super powered by AI. It's a world where a few people can have a truly outsized impact. And this is the change that directly threatens those old software pricing models. So, I'll leave you with this question to chew on. Knowing that the fundamental ways we pay for software and build our teams are changing right now, how does that alter your view of the future? Which companies do you think are going to thrive, and which ones are going to get left behind in this great repricing?